Sarah and Raj bought their Toronto dream home at the peak. Now, just 3 years later, their property's lost a quarter of its value. Monthly payments are set to spike, and headlines warn of an even deeper collapse. Nationwide, home prices have fallen 5.5% in a single year, and by 2026, nearly 1.2 million Canadians will face a mortgage renewal crisis. Everyone knows Canada's market was supposed to be unstoppable, so why is a much bigger crash looming? In this documentary, we reveal what really threatens Canadian home values and why the hardest shocks may still be ahead. Ultra-low interest rates once powered Canada's housing boom, but that era is over. As mortgage renewals approach in 2026, millions of homeowners face a new reality. Higher rates are pushing payments to the brink. Royal Bank of Canada projects home prices will barely rise, just 0.7% in 2025, before falling again by 0.7% in 2026. Senior economist Robert Hogue points out that Ontario and British Columbia are especially exposed, with affordability stretched to the breaking point. For many, a renewal letter means a jump in monthly payments of 30 to 40% or more. Families are cutting spending, taking on extra jobs, or preparing to sell, sometimes at a loss. Higher borrowing costs mean fewer buyers can qualify, while more owners are forced to list. The math is simple. As the cost of credit climbs, demand dries up. This interest rate squeeze is already changing the market's direction, setting the stage for even deeper trouble ahead. Across Canada's largest markets, unsold homes are stacking up at a pace not seen in years. In Ontario and British Columbia, listings now sit well above long-term averages, with Urbanation reporting more than 2,400 completed but unsold condos in Toronto alone by mid-2025, a figure that has doubled year over year. Developers once racing to keep up with demand are now facing a glut of inventory. Projects that launched during the boom are struggling to find buyers, and many are being delayed, converted to rentals, or canceled outright. The result is a growing backlog of units that weighs on prices, especially in the urban condo segment. This oversupply doesn't just threaten developers' balance sheets, it also sends a clear signal to the market. When supply outpaces demand, sellers are forced to compete, often slashing prices to attract interest. In regions like the Greater Toronto Area and Vancouver, the pressure from unsold inventory is building, creating conditions where even a small drop in demand can trigger a much steeper fall in prices. By early 2025, Canadian homebuyer confidence had collapsed to levels not seen in over a decade. The Reuters/Ipsos Canadian Consumer Confidence Index, which tracks attitudes toward jobs and major purchases, dropped to just 43.2 points in January, a sharp fall from 59.8 the previous year. Less than 15% of survey respondents believed it was a good time to buy a home, and more than 60% expected prices to keep falling over the next year. Behind these numbers sit real anxieties: rising mortgage payments, volatile job prospects, and a wave of trade and tariff disputes that have rattled the broader economy. Reuters' economics team notes that housing sentiment now mirrors the lows of the early 1990s and the aftermath of the 2008 crisis. Oxford economics' Tony Stillo warns that when confidence breaks, buyers freeze, sellers panic, and the market can quickly unravel. As sentiment sours, the risk of a deeper correction spreads from numbers on a page to households across the country. Toronto's housing market, once the symbol of unstoppable price growth, is now showing cracks that few can ignore. In the third quarter of 2025, the median home price in the Greater Toronto Area slipped to about $1.114 million, a 3.5% drop from the previous year. For condos, the decline is even steeper, with average prices tumbling 7.4%, wiping out most of the gains made during the pandemic surge. John Pasalis, a local real estate broker, describes the mood as anxious and uncertain. First-time buyers are sidelined, and investors who bought at the peak are now facing monthly losses. At Liberty Circle, a high-profile condo project in the city's West End, construction has ground to a halt. Developers missed pre-sale targets, lenders pulled funding, and buyers, some of whom put down deposits of $75,000 or more, are left hanging, waiting for answers that may never come. Urbanation reports that by mid-2025, there were nearly 2,500 completed but unsold condos in Toronto, double the inventory from a year earlier. The supply backlog is so severe that some buildings sit half-empty months after completion, while assignment sales, where buyers try to offload contracts before closing, are trading at losses of 10 to 20% below peak prices. Small landlords, too, are feeling the squeeze. Many who purchased multiple units are now underwater, unable to cover mortgage payments with rent. Some are resorting to short-term rentals, others are trying to sell in a saturated market, and a growing number are simply handing the keys back to their lenders. The GTA's condo glut, paired with stretched affordability, has turned what was once a safe bet into a warning sign for the rest of the country. Luxury towers once promised to remake Vancouver's skyline, but the city's high-end condo market has become a warning sign for the rest of Canada. In early 2025, a wave of new listings swept through neighborhoods like Cole Harbour and Yaletown, with dozens of units in recently completed buildings sitting unsold for months. The roots of the problem trace back to heavy foreign investment during the boom years. When the federal foreign buyer ban took effect in 2023, many overseas owners rushed to sell before the new rules locked them out. That flood of listings pushed prices lower, especially in the luxury segment where demand proved far thinner than developers had counted on. Market analysts point to half-finished towers along False Creek and the downtown core, where construction stalled as pre-sale targets were missed and financing dried up. One prominent project, once marketed to international buyers as a symbol of Vancouver's global reach, now stands empty, its future uncertain, with losses estimated in the tens of millions. Local media report that some investors who bought at peak prices are facing negative equity, unable to find tenants or buyers even at steep discounts. The investor retreat has created a feedback loop. As more units hit the market, prices slide further, prompting even more investors to exit. And CREA both warn that luxury and investor-driven developments in Vancouver are especially sensitive to policy shocks and shifts in global capital flows. With new completions outpacing local demand, the city's most expensive addresses have become ground zero for a broader correction that could ripple through the entire housing market. While Ontario and British Columbia dominate the headlines with steep declines and oversupply, not every province faces the same fate. In the Prairies, Quebec, and Atlantic Canada, the mood is far less dire. According to the Canadian Real Estate Association, these regions are projected to post modest gains in 2026, somewhere between 4% and 8% depending on local conditions. Cities like Winnipeg, Halifax, and Quebec City have sidestepped the wild price swings seen in Toronto and Vancouver. Their markets never overheated to the same degree, so the correction now is gentler. Rural and smaller urban centers have even seen a bump in demand as buyers priced out of big cities look for affordability elsewhere. During the pandemic, a wave of urban to rural migration helped push up prices in places that once struggled to attract new residents. In parts of New Brunswick and Saskatchewan, local agents report steady sales and a surprising resilience, even as national headlines warn of a crash. Still, these pockets of strength can't outweigh the drag from Canada's largest markets. Even with positive forecasts in the Prairies and Atlantic Canada, they account for a much smaller share of national sales. The overall direction of Canadian home prices remains tied to what happens in Ontario and BC. For now, the story outside the hot zones is one of cautious optimism. Steady, not spectacular. But as the weight of the national market shifts, no region is entirely insulated from the broader forces at play. A tidal wave of mortgage renewals is about to sweep across Canada. Between late 2025 and the end of 2026, nearly 1.2 million households, many in Toronto and Vancouver, will be forced to renegotiate their home loans. For most, these mortgages were signed in the era of rock-bottom rates, some as low as 1.9%. Now, renewal means facing rates 2 or even 3 times higher. CIBC's Benjamin Tal warns that the payment shock will be unlike anything seen in decades. For a typical family, this could mean a jump of 30 to 40% in monthly payments, hundreds, sometimes thousands of dollars more each month. The numbers are staggering. Roughly $600 billion in mortgage debt is coming due, much of it concentrated in high-priced, high-leverage markets. Many borrowers, especially first-time buyers and retirees on fixed incomes, will struggle to qualify under the new terms. Some will be denied refinancing outright, pushed to sell, or forced into default. TAL describes it as a stress test for the entire system, a moment where personal finances, market psychology, and the fate of the housing market collide. The renewal wave isn't just about numbers on a spreadsheet. It's about families bracing for a financial blow that could reshape their futures. Investors who once crowded into Canada's housing market are now scrambling for the exits. Urbanation reports that assignment sales, where buyers try to flip pre-construction contracts before closing, are routinely closing at losses of 10 to 20% below peak prices, with some forced sales in new Toronto towers hitting 25% off. These aren't isolated cases. Hundreds of small landlords, many holding 1 to 5 units, now face negative cash flow every month. Rent no longer covers the mortgage, and with prices sliding, options are limited. Some try to pivot to short-term rentals, but city bylaws and a flood of similar listings keep profits thin. Others are offloading properties into an already saturated market, accepting steep losses just to stop the bleeding. A growing number are simply mailing the keys back to the bank, a phenomenon known as jingle mail. Urbanation's analysts warn that as more investors cut their losses, the market absorbs a fresh wave of forced listings. Each new sale at a loss drags down comparable values, making it harder for the next seller to break even. This feedback loop accelerates price declines, especially in the condo-heavy cores of Toronto and Vancouver. The pain isn't confined to individuals. As investor exits pile up, the effects ripple outward, straining city budgets and reshaping local economies. Toronto's city budget depends on a steady stream of revenue from real estate transactions. In 2022, the city collected over $1.3 billion from its municipal land transfer tax alone. But as the housing market cooled, that number dropped to $948 million in 2023, and mid-2025 figures show receipts falling further, tracking closer to $830 million. Development charges, which fund everything from transit to parks, have also slipped, down more than $100 million since the market peak. The result is a growing budget hole. Toronto's 2025 financial statements link a $186 million shortfall directly to fewer home sales and lower prices. City Hall now warns that if the market doesn't recover, the gap could reach $300 million by the end of 2026. Vancouver faces a similar dilemma. Property transfer tax revenues are projected at just $133 million for 2025, a steep decline from $187 million a few years earlier. Development levies and community amenity contributions, once flush during the boom, have fallen by half. City officials caution that up to $80 million in services could be at risk if housing revenues remain weak. For both cities, the slowdown means tough choices: cut spending, delay infrastructure, or raise property taxes. As home values drop, the wealth effect fades too. Families spend less, businesses feel the pinch, and local economies lose momentum. What began as a housing correction now ripples through city budgets, threatening the services and investments that keep urban life running. Facing a mortgage renewal in 2026 doesn't have to mean disaster if you prepare early. Start by reviewing your mortgage documents to pinpoint your renewal date and current rate. Reach out to your lender months in advance to understand what new payments could look like at today's rates. If the numbers seem unmanageable, ask about extending your amortization or switching to a shorter-term fixed rate to buy time in a volatile market. Compare offers from other lenders and don't hesitate to negotiate. Many banks are willing to compete for your business, especially if you have steady income and equity. If your budget is already stretched, make a plan now. Trim discretionary spending, build up an emergency fund, and consider whether downsizing or renting could offer relief. Staying proactive gives you options, even as the market shifts around you. Timing a home purchase in this market is anything but straightforward. Lower prices might seem like a green light, but high interest rates can erase those savings in monthly payments. Some buyers are tempted to jump in, fearing prices will rebound, while others worry about catching a falling knife if the downturn deepens. The dilemma is real. Even if discounts appear, borrowing costs can keep ownership out of reach for many. Locking in now could mean higher payments for years, while waiting risks missing out if rates drop but prices stabilize. For those considering a move, the safest approach is to weigh both sides. Look closely at your personal budget, monitor local inventory, and remember that affordability isn't just about the sticker price. In a market this volatile, patience and caution matter as much as timing. Capital is moving with caution as investors look for safe havens beyond Canadian real estate. Political commentator Tasha Carradine notes that efforts to boost housing supply have run into red tape and local resistance, blunting the impact of federal targets. Policy shifts like adjusting immigration levels or tweaking development charges are often too slow to offset the rapid changes in market sentiment or global capital flows. For investors, the message is clear. Diversify holdings and avoid overexposure to single markets, especially those with high leverage and weak rental demand. Policymakers, meanwhile, face a dilemma. Intervening too aggressively risks prolonging the imbalance, while inaction leaves households and budgets exposed. The system rewards those who stay nimble, read the signals, and recognize that government backstops have limits when affordability and liquidity dry up. Since early 2022, Canadian home prices have fallen by about 25%, with Ontario and British Columbia leading national declines. The evidence is clear: a perfect storm of higher interest rates, oversupply, and record low buyer confidence now threatens a deeper correction in 2026. Over 1.2 million households face mortgage renewals at much higher rates, and cities like Toronto and Vancouver report rising listings and stalled construction. Yet some questions remain. Will government intervention change the cycle, or will resilient regions offset the losses in major markets? What is certain? The era of guaranteed price growth is over, and both families and investors must adjust to new risks. As documented by Royal Bank of Canada, CIBC, and Statistics Canada, the housing market's next chapter will be shaped by the hard math of debt, supply, and demand. For all Canadians, these facts signal a critical turning point.